Welcome to The Explainer. Today, we're cracking open the playbook. We're going to look at how the most sophisticated investors and business owners legally, and I mean legally, shrink their tax bill. We're going to break down the core mechanics they use step by step. All right, so let's just dive right in with the big question. You hear it all the time, right? How can some of the wealthiest people pay a lower tax rate than their own assistants? And look, this isn't just some clickbait headline. It actually points to a really deep structural feature of our tax system. The assumption most of us have is that everyone's playing the same game by the same rules. But, well, that's just not true. And here's the answer. The core secret, according to tax experts, there isn't just one tax system. There are effectively two. There's one for people who earn a wage, a salary. And then there's a completely different one for people who own things, for owners and investors. So this is the absolute key to everything. The most important factor in how much tax you pay isn't how much money you make, it's how you make it. Your ability to control the type of income you have, that is the foundation for every single strategy we're about to talk about. You see, the tax code basically splits all money into three different buckets, and they are treated so differently. First, you've got your earned income. That's from your job. It gets hit with the highest tax rates, and taxes are taken out of your paycheck automatically. Then there's portfolio income, which is from selling assets like stocks. This gets way better preferential rates. And finally, you have passive income, which is often from things like real estate. And this one comes with its own super powerful set of deductions. Knowing these three categories is like knowing the rules of the game before you even start playing. I mean, just look at that gap. A 17-point difference between the tax on your paycheck and the tax on your investments. That is not some small loophole. That's a giant flashing sign built right into the tax code. And the main goal of any advanced tax strategy is to legally move your money from that high tax earned bucket into those lower tax portfolio or passive ones. Okay, so let's get into the first big strategy, the capital gains playbook. This is exactly how investors use things like stocks to build wealth with just incredible tax efficiency. So the first move here is so simple, but it's incredibly powerful. All you have to do is hold an investment for more than 1 year before you sell it. That's it. That one little timing decision flips your profit from being a short-term gain, which is taxed just like your regular income, into a long-term capital gain. And boom, just like that, you've unlocked those much lower tax rates we just saw. And this is where we see the magic of tax deferral kick in. Let's say your stock portfolio goes up by $1 million. You know what your tax bill on that growth is? Zero. Nothing. Not until you actually sell. So that unrealized gain can just sit there and compound for years, even decades. All the money that you would have paid in taxes is still in your account, working for you, making your wealth grow that much faster. But that brings up a pretty obvious question. What if you actually need the cash? How do you get that money out without selling and getting hit with a huge tax bill? Well, this is the really clever maneuver. You borrow against your assets. A loan you take against your portfolio isn't considered income, which means the money you get is completely tax-free. This trick gives you cash to live on or to make new investments, all while your original assets keep on growing, still untaxed. Okay, time for our second play, the real estate machine. And trust me, when you talk to tax strategists, they discuss this asset class with a special kind of reverence. It offers tax benefits that just blow away what you can get from the stock market. To really see how this machine gets going, let's walk through a super simple example. Let's say you buy a $1 million investment property. Okay, right off the bat, the tax code does something really interesting. It splits your $1 million purchase into two pieces. There's the land, which you can't deduct, but then there's the building, and the entire value of that structure can be turned into tax deductions. And this magical deduction is called depreciation. It is the absolute engine of the real estate machine. It's what's known as a non-cash expense or a paper loss. You're not actually losing any money, but you get to use this paper loss to lower your taxable rental income. And here's the crazy part, the paradox at the heart of it all. You are taking a massive tax deduction for an asset that, in all likelihood, is actually going up in real-world value. Now, normally you'd have to spread this deduction out over about 27 and a half years, but of course, the pros don't do that. They accelerate it. They use a strategy called a cost segregation study, where they basically break down the property into smaller pieces. The carpet, the light fixtures, the appliances, things that wear out faster. This lets them cram huge deductions into the first few years they own the property, creating massive paper losses right away. And this, right here, is the real endgame. Why do they want these giant paper losses? Because under certain IRS rules, you're not just limited to using them against your rental income. If you qualify as a real estate professional or use a specific short-term rental strategy, you can take those losses from your real estate and use them to wipe out the high tax income from your main job or your business. It's a game changer. All right, time for the final play. And this one isn't just about reducing taxes during your lifetime, it's about eliminating them completely when you pass that wealth on. This is the secret to securing true generational wealth. This might just be the single most powerful provision in the entire tax code, and honestly the most misunderstood. It's called the step up in basis. So let's say you bought a stock for $100,000. And when you pass away, it's worth $2 million. Your kids who inherit that stock, they get a brand new cost basis of $2 million. That $1.9 million profit, it's never taxed. It's just legally erased, gone. Okay, so now let's connect the dots. Let's put these plays together. An investor can use play number 1, borrowing against their growing assets, to get tax-free cash for their entire life. Then, when they pass away, those same assets, which they never sold, get the step up in basis from play number 3. The result? A lifetime of tax-free money, followed by a pretty much tax-free inheritance for their family. It's an incredibly powerful combination. So, what does all of this mean for you? What's the real takeaway here? How do you go from just, paying taxes to actually planning for them? Well, it really comes down to a fundamental shift in both your team and your mindset. The first thing you have to understand is this critical difference. A tax preparer is like a historian. Their job is to look backwards at what's already happened and report it accurately to the government. A tax strategist, on the other hand, is an architect. Their job is to look forward and design a blueprint to legally minimize your taxes in the future. Most people have a preparer. The wealthy build their team around a strategist. And that brings us to the final and maybe the most important mindset shift of all. You have to stop looking at the tax code as just a big book of penalties. According to the experts, it's really a policy document. It's a map of government incentives. All those huge tax breaks for real estate and business owners, they exist for a reason. The government wants to encourage people to provide housing and create jobs. Strategic tax planning is just the process of aligning what you do with your money with what the government is already incentivizing. So I guess I'll just leave you with this final thought to chew on. Moving forward, are you going to keep preparing your taxes just looking in the rearview mirror? Or are you going to start building a tax strategy looking ahead through the windshield? That's the choice.